What's up, guys? David, Pro Duo Flippers here, half of Pro Duo Flippers. My wife and I are full-time eBay sellers. I have been full-time selling on eBay for about 2.5 years. My wife has joined me about 9 months ago. I've been selling total on eBay for 20 plus years, part-time, took some time off completely. Anyway, today I want to make a video about income taxes. I want to talk to you about mistakes that we have made. Kind of want to talk about, just give you some advice, some tips on how to save some money, how to avoid some mistakes that we made as we were starting out, and mostly as we were growing and converting into full-time sellers. We made a couple huge mistakes. Our fault. CPA, was it our CPA's fault? Yeah, I would say it was his fault too. So let me just kind of start and talk about this goes for eBay, Amazon, Poshmark, Mercari, wherever you're selling online. Basically, when it comes to income taxes, it's going to be the same game. So I can talk real briefly about what kind of deductions you take. So because that's very relative to what the video here I'm talking about income taxes. So basically, what you're going to take is whatever money you have coming in. Your gross sales plus whatever you've charged for shipping, that's going to be your total income. And then from there, there's some things you can take off for your expenses to get down to what your net is. So first and foremost, you want to take off your returns or your refunds. So you have your gross sales, including the shipping charges. That's your total. You want to take out your refunds and returns for the year. So you want to track those throughout the year. And for me, I track everything on a spreadsheet. You can watch my other videos to see the spreadsheet that I have. It's also available for sale for $9 if you need something to track your expenses. There's other ways to do it, QuickBooks or different or GoDaddy, or use your own CPA, or write it down on paper, however you want to do it. But you do need to keep track of your numbers. So you have your gross sales plus shipping. Take off your returns, refunds for the year. And then there, you're just going to start deducting your expenses that are straight up deductions. So that's your cost of goods sold. So whatever you paid for inventory for the items that sold, you'll subtract that. Your fees. So any fees that you're being charged by eBay, Amazon, PayPal, whatever, any kind of fees that are related to your sales, you'll deduct those. Shipping charges, which is probably going to be one of your highest expenses, if not your highest. I think that my shipping charges last year were actually a little bit higher than my inventory. So it's a very high cost of selling online, is shipping all that out to your buyers. And then you have some smaller things too, like just your supplies. So any packaging materials, anything that you use for your business, and it has to be 100% for your business, I would assume, or maybe you only deduct a portion if you're using it for your business and for something else. Like I bought a laptop that I only use for my business. Anyway, so supplies and expenses, those are relatively end up being small probably for you, unless it's your first year and you're setting up a home office or something. Then you might have some bigger expenses for desks or tables or lighting equipment or something like that. But and then from there, you could also deduct your internet charges and cell phone charges if they're using just for that, or a portion of it. And then also there's two other things that you can deduct. One is your mileage. So if you just track your miles that you're using just for your business, so if you drive to the thrift store and back, you can deduct the miles for that. You basically just want to tally up those miles for the year, and then you make something like, you get a deduction that's something in the neighborhood of 52 or 53 cents per mile or something. So it can end up being a significant deduction as well. And then the last one is maybe I guess if you're bigger and you have a lease space, you could deduct that lease charge, or if you have a warehouse or something like that, you can deduct that. If you don't, if you're working in home, then you can take a home office deduction, and that would be just for the percentage of your house that you're using solely for the business. So it can't be something, you can't deduct your living room if you sit in there and list. It has to be a spot in your house that's used exclusively for your business. So and the way that works is you take your total square footage, and then you figure out the percent of your square footage that you're using just for reselling. So for me, I have a 1,200 square foot basement. We have a 4,500 square foot house. So whatever that percentage comes out to, I can't remember exactly. I think it's somewhere in the neighborhood of 30%. We can deduct 30% of our mortgage payment, our power, gas, and water. So that's how that works. And that's a pretty significant deduction too. And then there's one other thing, I guess you can also deduct your health insurance premiums. So if you used to get health insurance through your work, you no longer do it. And now because you're self-employed, you have to go out and purchase private self health insurance. You can deduct that premiums as well. So that's kind of a whole lot of deductions, and that's kind of a breakdown of it. So that's a lot of stuff to keep track of. And so, like I said, I recommend a spreadsheet or QuickBooks or GoDaddy or whatever you're going to use so that you're keeping track of it throughout the year. It makes it very easy at the end of the year to do your taxes. But basically, what I really want to talk about is just some of the mistakes I've made as far as income taxes. There's just a few, but they ended up amounting to thousands of dollars. So at first, when you're first doing this, let's say you have a full-time job, you're just doing this on the side. All I really recommend that you do is at your work, go in and claim fewer, whatever you call it. What do you call it when you collect dependents or whatever like that? So you want to be, maybe even if you're married and have a couple kids, I would try to get it down to just claiming single and one or zero or something like that, so that they're taking a little more out than they need to be, and that will cover the extra income that you're going to make with your reselling. So, and by the way, any amount that you make reselling, you should be claiming on your taxes. That's the law. I know there's probably a lot of people who don't do that. That's your choice. But any amount of profit that you make should be claimed on your taxes. So I would start doing this from day one if I was you, and then you'll have a track record showing that when you get bigger, that you were claiming this income as taxes previously before you got so big. But and then here's where you really need to be careful. So I'll tell you about the first mistake I made when I went full time was I just really underestimated how much tax I was going to owe for that first year of full-time reselling, where I didn't have any taxes taken out. And so what really hits you hard when you're doing reselling is what they call self-employment tax. So normally when you work, your employer pays Social Security, Medicaid, and that kind of thing for you. That's part of the taxes that they pay for having an employee. But when you're self-employed, that stuff still needs to go to the government. And so you get taxed at your regular rate, plus they tax you extra for that self-employment tax. And so if you don't account for that, then you could be finding yourself having a large tax bill at the end of the year. And so what they want you to do is pay quarterly taxes, quarterly estimated taxes. So you kind of need to figure out, and this is why it's important to meet with a CPA. And I'm going to talk a little bit more about picking the right CPA in a minute, but you want to meet with a CPA so you can really estimate where your taxes are going to be. Talk to your CPA, tell them how much you expect to make, and so they can give you a great, very specific idea about how much you need to be paying in taxes quarterly. And you'll send those into the government like 4 times a year. I believe the first one is technically on April 15th when your taxes are due for the previous year. You'll do one then, and then there's 4 throughout the year. The last one will be January of the next year. I can't remember the exact months. I want to say it's April, June, either June or July, and then maybe September, and then January is when the last one's due. But here's the mistake that I made. I didn't figure high enough at all, and so I think I was paying something like, well, the first year I didn't pay any estimated taxes. I didn't really think about it. So we always were making plenty of money and never had to worry about if we had to pay money or not. But anyway, the first year where I had full-time income, we ended up having to pay about $10,000 at tax time, because we just didn't realize how much we needed to be saving or paying quarterly payments. We weren't making quarterly payments. And so anyway, that was the first mistake we made. And that was pretty huge. That was kind of like, we weren't prepared for it. We didn't have money saved up for it. I think we had a few $1,000s saved, and I think we were able to come up with another couple thousand, and then we ended up putting like $5,000 on a credit card. We later got it paid off, but just a big blow that we weren't expecting. So maybe you guys can avoid that going in the future. That make sure, even if you're not doing quarterly taxes, that you're at least saving that amount of money, so that when your first year comes up, that you have that ready to go. And then I would say, really, the only other mistake we made was another big one, and that's at some point in your business, you're going to be making enough money where you should no longer be taxed as a sole proprietor. You really need to set up so that you're being taxed differently, so that you're being taxed as an S corp. So the way we did it was, and here's where I'm saying, I guess I'll talk now about why I kind of blame our CPA a little bit. So he's a great guy. He's super nice. He did a good job for what he was doing, but I don't think he just had very much experience with people who were self-employed. And he didn't give us the advice that I felt like he should have been giving us. So I kind of heard this watching other resellers, that when you get to about 40,000 in income, I'm not talking about sales, I'm talking about after all your expenses, and you're at about $40,000 in net income that you're actually going to pay taxes on, that's about the point where you need to be switching to a different business structure and start being taxed as an S corporate and paying yourself a salary. And I'll kind of vaguely explain or briefly explain how that works or what that means. So what that means is, so for us, we set up an LLC, and then we applied to be taxed as an S corp, an S corporation. And what that means is now we pay ourselves a salary. So you kind of figure out what a fair salary would be to pay somebody who is doing the activities that you're doing. So for us, I think we ended up saying that I can't really remember exactly. I want to say maybe 20,000 each for both of us. So for that 40,000 of income, so 20,000 for me, 20,000 for my wife, or maybe we figured 25,000 for me and 15,000 for her, because I do more of the business management duties. It doesn't really matter. But the point is 40,000 of our income is now being taxed as payroll. And with that, we still have to pay like the extra taxes or whatever. And so, but on the rest of it, our business will still make more than $40,000. The rest of it will just be business income. And that portion won't have to pay that extra, what would have been self-employment tax. So let's say we make another 40,000 on top of that. That's like that amount of tax that we have to pay less taxes on, or that much of income that we pay less taxes on. So for us, that meant saving about $6,000 or so. So, so my point is, when you get to about 40,000, you really need to talk about your CPA. If your CPA isn't advising you to set this up, then you might want to be looking into a different CPA. And that's kind of what we did. I kind of asked him about these things, a couple different things. One was how we were doing our home office exemption. There's two different ways to do it, and one is just a standard deduction kind of a thing, and the other one is more complicated, but could potentially give you more of a deduction. He discouraged us from doing that one when he probably shouldn't have, based on the tax laws, and then he also discouraged us from filing as an S corp. I don't know why. Maybe he doesn't like to do business tax returns. I don't know. Maybe he doesn't have very much experience with it. But after listening to some other big resellers over the years, I realized maybe it was time to switch to somebody else. And then, so we did. And so we had our taxes done this year. We paid about $500 or $600 maybe to set up the LLC and set up the online payments for our tax, our federal income tax payments and our state tax income payments. And so we got that set up. We also paid, because he looked at our previous year's tax returns and realized that our CPA before had done something else wrong with our health insurance premium deduction. And so he amended our tax return there and got us like another $1,100 back or $1,300 back. So be very careful about your CPA. I highly recommend that you talk to a CPA. Make sure you're talking to one that knows how to do taxes for businesses and not just individuals. Even if it costs you more money, they'll probably save you enough money, more than enough money to make a difference. So as far like we were paying our first CPA like $120 to do our taxes, and now we're going to pay this new guy maybe $200. I mean, that's not a huge difference, and he's saving us thousands. So anyway, so find a CPA that knows what he's talking about. And when you get to that level, make sure you're setting yourself up for an LLC and to be taxed as an S corp, so that you're not throwing money away, which is really what we're doing. And then and that way you'll also be, the way it works once you've done that is you'll set up a business account, checking account if you don't already have one. Have all your money flowing into that from the business, flowing into that checking account, and then you'll pay yourself from that account a payroll, a payroll basically once a month, or however you want to do it, I guess. And that money that you pay yourself will be like the after tax amount. And then, so for us, we are going to pay ourselves basically after taxes for the both of us. We are only paying ourselves like maybe $3,000 a month, and then at the same time we have to pay taxes on that. I believe we pay about $1,100 a month to the IRS, and another $200 a month to the state or something like that. And then you can still pull more money from that business account as income. It just won't be, payroll income or employee income. It'll just be pulling in profit from the business, and then that profit, that money that you pull, will be taxed differently than the payroll. It'll be taxed at a lower rate. So anyway, I don't know if this is all clear. Hopefully this makes sense, and that the couple things that you want to do to save money. So basically, when you're first going full time, or basically when you're first doing it on the side, just claim less dependence on your income at work, and so that they're taking more out that will cover your extra income that you have from reselling. Once you go full time, make sure that you're saving enough or paying enough in quarterly taxes that you're not going to have a huge tax bill at the end, at the end of the year or the next year when you go to do your taxes. And then as you grow, make sure that when you're getting close to that $40,000 threshold, you're talking to your CPA and timing it right so that you will have yourself taxed differently as an S corp or something, so that you can get that tax savings and not throw it away. I don't know what we threw away, $6,000 to $8,000 on that first year. So that's a lot of money. Anyway, that's kind of it. That's all I had. I just want to throw out those couple big pointers for saving some money, as you're growing your reselling business, especially for those who are going full time. If you guys have any questions or comments, leave them down below. Hopefully this was clear, but maybe I can clear up any questions you might have. Just leave them in the comments and I'll answer them for you. Anyway, like, comment, share if you can. Follow us on Instagram. Pro Duo Flippers there as well. And have a great day, guys. Thanks.